Okay, good afternoon and welcome back everyone to our options education webinar series. My name is Tony Zhang. I'm the chief strategist here at OptionsPlay. And today we're going to be talking about how to prepare your portfolio for the recession. Now, the last time I did this webinar was actually on January, I think 4th or 5th, about a month and a half before the last sell-off. Now, we've obviously since then had a significant sell-off of about 33% in the markets. We've recovered most of that. And now we are actually in a recession. When I was talking about this in January, we were talking about in the context of if and when there is a recession, this is how you prepare your portfolio. Now we're actually in a recession or about to enter into a recession. We want to talk about how to prepare your portfolio as well, because we've rallied most of the sell-off back. And I think many investors feel that there are a bit of a disconnect here in the markets as far as when we might get a pullback. How we're going to get that pullback is yet to be seen, but that's exactly why we want to talk about this type of topic now, so that you are prepared, so that when you do, if and when we do get another sell-off, you know how to prepare your portfolio. More importantly, you know what to do with your portfolio now to prepare for that eventual sell-off. So those are the things we're going to go over here today. Let's go ahead and get started. Before I do, just a quick disclaimer. What we're going to discuss here today is purely for educational purposes and not a solicitation or recommendation to buy or sell any specific securities. And for those of you that are brand new to OptionsPlay, we're going to be showing you not only the slides, but also a platform that allows you to analyze the trades that I'll be showing you here today, so that you become self-sufficient in being able to analyze these trades on your own. So you can sign up using that a free trial for the tools that I'll be showing you here today by going to trade.optionsplay.com/join. And I just posted that link into the chat window for those of you that want to follow along. So if you have not already signed up for a free trial, it gives you access to free daily trading ideas, options education like the one you're on here right now, as well as access to a full video library so that you can look at all the other topics as far as how to learn how to trade options. So let's go ahead and get started. I'm going to start off today by talking a little bit about the current market outlook, because I think it's very important. Now, I'm not going to spend too much time going into that. I'm just going to do a brief overview. For those of you that want a more in-depth market outlook, please join me tomorrow morning at 9 a.m. where we're going to go over the current markets, the research we're looking at, and what our expectations are going forward. So we're going to look at the current market. We're going to talk a little bit about what we expect, what we see right now, what we're expecting going forward. Then we'll talk a little bit about the portfolio hedge, specifically regarding what are your options with hedging. And I want to be clear that when we talk about a portfolio hedge, you actually have multiple options. We are here to tell you briefly about what two options are, and then we're going to spend most of our time talking about what's called a portfolio hedge. So we're going to talk about how to position yourself where you remain invested in the markets, so that perhaps you still continue to capture dividends, still continue to capture an income stream, but protect yourself against a market correction. Now, some of you may not rely on dividends very heavily. For those of you that you might want to get out of the markets, those are all options. We're going to discuss what those are. Then once we understand what a portfolio hedge is and understand timing around a portfolio hedge, then we'll talk a little bit about what are the optimal portfolio hedges. And the best thing to do is really just to show you OptionsPlay, put the two side by side so that you can compare it, so that going forward, you again become self-sufficient in being able to do this on your own. So those are the things we're going to go over here today. So we'll start off by talking a little bit about the market outlook. Now, this is something that we discuss very heavily every Tuesday and Friday morning. For those of you that do join us, I highly recommend you to do that tomorrow morning if you have not joined us here before. So as I said before, we've sold off about 35% from that February 19th high. We have rallied most of that back. We're just sitting around the 61.8 fib retracement level, which happens to coincide with the 20-week moving average. Now, that's currently still holding on the weekly chart. The daily chart looks a little bit more constructive. The daily chart, we've had multiple waves of continued rallies. This last wave certainly has weakened a little bit more, and if you look at the momentum, Every subsequent rally has continued to keep the momentum indicator sideways. These are the signs of exhaustion that we typically see. And we're going to zoom in a little bit and see, and we're going to also look at the rally from the November to February highs. We're going to look at how we're seeing many similarities right now in the last few days as we have with the rally going into the February 19th sell-off. So that's what we're currently looking at. Now, that's the broader market. What I also want to take a look at is really, we know that we're currently in a very different world than what we were in back in February, early February and January. So what we want to look at is kind of where things are different. So right now, one of the things that we've noticed is that small caps is not joining on this particular rally, right? And someone said, Vincent said something about volume. I'm going to come back to that, Vincent, but absolutely volume is something that we're looking at. But small caps sold off just as heavily, but has not bounced back nearly as much. It hasn't even reclaimed the 20-week moving average. It did reach it just very briefly, but got rejected, as you can see right here. Small caps, as far as momentum, actually looks a little bit more constructive than the S&P 500, but small caps overall still sitting right below some major support levels. Now, this is the December 2019 low. It's still trading below that. So small caps have not gotten back to where we are trading versus the S&P 500 is back near, June, July highs of last year. This is still back at the December 2018 lows. So small caps looking very different. And then on the flip side, you have technology looking extremely strong. If you look at the NASDAQ 100 or the Qs, we have basically claimed back almost 80% of the initial sell-off. That is a very different picture. So going forward, we really see a bifurcation in the markets. And when we talk about investing in a post-COVID-19 world, that's really there's really going to be a big bifurcation across have-nots and haves and have-nots in this particular world in terms of how you invest. And technology certainly, or certain areas of technology certainly will be strong in this particular sector. So if you look at Zoom Technologies, you look at even Roku, which reports earnings today, you're going to see clear winners and losers as a result of COVID-19. So we want to be careful as far as how we position ourselves in this particular sell-off. It's important to understand where there's strength, where there's weakness, and focus on where there's weakness when you're thinking about a sell-off here in the overall market. But technology certainly looks stronger. Momentum, very similar picture, is really moving sideways. As Vincent said, pretty much on all of the indices that we track, volume is actually continuing to decline on such rallies. That is the type of exhaustion that we really saw going into the February 2020 highs. And also money flow across the board on all the rallies have been very, very weak, telling us there are, again, signs of exhaustion. These are the same signs of exhaustion we saw going into February. We obviously couldn't have possibly predicted COVID. Many times we can't predict what the catalyst that actually moves the market, but we can predict that something signs of exhaustion in terms of the market. What's really difficult to do is to actually time when the correction is actually going to happen. I would argue that it's impossible to time when the correction is going to happen. And that's why it's so important to discuss timing and what to do, because you can't just go out and buy puts. It's going to be too expensive. We're going to talk about those things. We're going to talk about what can you do to prepare your portfolio now so that even if this sell-off doesn't take another month or 2 months or maybe 4 months to materialize, how do you prepare your portfolio during that time? So those are the things we're going to discuss here today. So first, let's talk a little bit about what are your options going into a recession. First and foremost, there is a strategy called a perfect hedge. Now, someone actually sent me an email about a month ago referencing this particular topic that I discussed here in January, saying thank you so much for telling me that there's this thing called the perfect hedge, because that's exactly what I did, and I was able to save my portfolio from most of that sell-off. I think I got this email back in March. I tried to find it and show you guys, but I couldn't quite find it. I just get too many emails. If you wrote me that email, please tell me here in the chat window. I'd love to discuss that. But there's a thing called a perfect hedge, meaning moving your assets into cash and then simply reinvesting it after the correction is over. So think about, you know, if you're looking at the overall markets, as you notice that things are kind of reaching this kind of peak. Whoops. Notice that markets are reaching a bit of a peak, and thinking about reinvesting, or thinking about investing moving your assets into cash and then reinvesting it when you think that the market has bottomed. That is what we call a perfect hedge, because it doesn't cost any money other than the commissions. It is the most efficient way to hedge your portfolio because it gives you dollar for dollar hedge. You can't lose anything if your money's not in the markets. So that is what we call a perfect hedge. If you have the ability to do that, you certainly should, or certainly is one of the strategies that you should explore. Now, not everyone has the ability to take all of their assets out and remove it to cash, and maybe many of you don't want to, right? So then you have other options. You can reallocate to more defensive assets. First and foremost, fixed income comes to mind for many investors to move into a lower risk category of fixed income. Many times you're looking at treasuries or investment grade bonds. So either something like a TLT type ETF or LQD for investment grade in terms of fixed income. You can also think about defensive sectors like staples, utilities, and specifically stocks with fairly stable dividends, telecoms, those types of stocks. The only thing I want to be careful of is that typically, many times, you might find a lot of stocks that have very high dividend yields, such as energy. Energy, yields 4 or 5%, many yielding significantly higher than that. But keep in mind that when you think about dividends in a recession, the important piece is stable dividends, not just high dividends. Many times I see investors move towards high dividend paying stocks, thinking that that's going to provide protection. But many times those very high dividend stocks are the ones that are at most risk of cutting their dividends in a recession. So focus on stocks that have history of paying dividends through economic recessions. Many times banks fall into that category. Utilities, those are the types of firms that you want to think about investing your cash into. Lastly, many people put their money into gold. That certainly has been a very popular trade at the moment. Gold continues to rally. Many of the gold miners is also a leverage play, if you will, on that. That's something we actually covered on Options Action this week. So those are some of your options that you have that do not involve any options. So if you're not comfortable utilizing options in your portfolio yet, or if you're still learning, you might want to take one of these two defensive plays for your portfolio. Now, for those of you that want to trade options or want to explore utilizing options for your portfolio, that's when we can talk about a portfolio hedge, which is buying a put option to protect your portfolio. Now, I want to make sure that people are clear as far as how this works. Now, buying a put on your portfolio is something that you should only consider if you believe that there's going to be a correction that's at least 5%, typically a little bit more, like 10 to 20% or greater, for you to buy a put option. You can hedge against 5 to 10% correction, but many times this is for when you anticipate a much larger correction. And this is for those of you that own a stock or ETF portfolio and you do not wish to sell any of your holdings. Now, or perhaps most of your holdings. So I want to be very clear that this is for those of you that are invested and you want to remain invested, but you are concerned about a correction that's typically greater than 5 to 10%, okay? Now, that's what we're going to spend our time exploring here. That's what we're going to talk about, how to go about doing so with this type of strategy. So what is a portfolio hedge? The best way to think about a portfolio hedge is thinking about an insurance policy on your portfolio. Now, the thing about insurance policies on your portfolio is that it's very expensive, and we're going to talk about how that affects your decision to buy a portfolio hedge. Because when we think about insurance policies, we usually think about something that we buy all the time in case something happens. It's not quite the same for buying a put on your portfolio because it's very, very expensive. So buying a put option on a broad-based index, so could be something like SPY, SPX, any of the broad-based indices that track your portfolio. We're going to talk a little bit about that here in a second. And what's going to happen here is when you buy a put, if the market starts to correct lower, your puts will generate a profit. Now, when you generate a profit, what that's going to do is it's actually going to offset your portfolio losses. So when you buy a put option, what actually happens is that you're still going to receive you're still going to have a loss in your portfolio. It's just that you're going to have a gain on your put options that's going to offset a portion of your losses. Now, this creates what we call an imperfect partial hedge, meaning it's never going to hedge your portfolio dollar for dollar. You can get it close, you can get it close enough, but you're never going to experience dollar for dollar exposure. And many times you don't want to hedge your entire portfolio. Most investors hedge a portion of their portfolio because again, buying puts or buying protection on your portfolio is very, very expensive. And I cannot stress enough how expensive buying portfolio hedges are. So it's something that you cannot do all the time. If you tried to buy puts all the time, you're going to cause a severe drag on your portfolio, and your portfolio is going to underperform the market severely. I would argue that if you constantly bought puts, your puts will probably cost more than the gains that you get in your underlying portfolios. So this is a strategy that requires active management and timing. And we're going to talk about some of those things here today about how to actively manage it and how to think about timing for a portfolio hedge. So just for a very quick visual representation of a portfolio hedge for those of you that are new to options trading, think of this as your portfolio. Your portfolio can either go higher if the markets go up, and it can suffer losses if the market goes down. So this is when the market goes higher, and this is when the market goes down. So as the market goes higher, you make money. As the markets go down, you lose money. Simple to understand. What you're going to add to this is a put option. A put option gives you gains when the markets go lower and has cap losses. So if the market continues to move higher, you pay whatever you pay for the put option, that's the most you can lose. So that if the markets continue just marching on higher, like we are doing right now, that you're not taking on further losses from the put option. Now, when you combine these two together, when you combine your portfolio with the put option, what you get is a chart that looks very similar to a call option. And actually, back in the day, before put options were invented, you could actually trade a synthetic put utilizing stock and calls. And this is really how put-call ratio is created. So what happens is that if the markets continue to go higher because after you've bought a put, you will still participate in that overall rally because a put option has limited losses. Now, if the market was to continue moving lower, that's when the gains in your put option will be offset by the losses in your portfolio. So what that means is that if the markets continue to move lower, you will suffer, let's just say, smaller losses in your portfolio than if you didn't hedge it. So reality, the chart will probably look something like this rather than a straight line, because a straight line infers that you have received a perfect hedge. As we said, that buying a put option is an imperfect hedge. So what you get is a line that's significantly better than if you kept it unhedged, but it is still going to generally have some losses if the market continues to move lower and lower. Okay, so that's the basis of a portfolio hedge. Now, let's talk a little bit about timing. Now, before I jump into the timing, I want to ask a quick question here. So I have a poll here on the screen. Where do you see markets in 1 month? Higher, lower, or if you're not sure? Please answer this poll here. I just want to get a sense for the room here. Okay, so good portion of you have voted now. About 50% of you say lower. Only 16% of you say higher. And 32% of you say you're not sure. Okay, great. I think that is a great answer. Okay, so 49%, basically half of you are pretty confident that the market's going to be lower. 33% of you say you're not sure. And I think many people fall into this category of basically saying, I think the markets should be lower, but every single day I look at the markets keep going higher. It's not going any lower. No matter what type of economic numbers come out, no matter how bad things look, markets keep staying sideways or moving a little higher. And then 18% of you say you think it's going to move higher, similar to kind of what we saw back in January and February. Even though we kind of all felt that a correction was on the road, that it was coming up, the markets just kept grinding higher, and that's exactly what we're seeing. So I think that what you guys are expressing here in the markets reflects what many of us feel. Okay, so first I'm going to talk a little bit about timing. Okay, so because timing is really important, not only for the correction itself, but I think more important, leading up to the correction. You know, at this point right now where there's a pretty big, I would say, disparity as far as how we view the current markets. Right now, one of the things is that prior to a sell-off, what we typically see is that markets will generally stall, or at least there will be signs of exhaustion in the markets. And if we look back to what we saw back from the November breakout, so you know, the markets traded in a very range bound market between April and November of last year. And then in late October, early November, the market started to break out. And as it broke out, it really provided very few pullbacks, but just continue to grind higher, you know, pushing us to all-time highs, pushing us to all-time highs, pushing up to peak valuations, historically speaking, at least since the 2008 financial crisis. And you know, during a time where economic activity wasn't looking particularly strong, or certainly wasn't growing at that type of pace, which is why many people thought that the markets were getting a little ahead of itself and a correction was coming. But we certainly could not anticipate that the COVID-19 was going to hit. And this is what I'm going to call a not bullish phase. And I want to be very clear, because I want to make sure that there's a distinction between saying that I'm not bullish versus saying that I'm bearish. Okay, so I would say more than, you know, the 33% of you that said you are not sure, this is probably the best way to sum up what you currently feel the markets are. You're not bullish, you're not bearish. I'm sorry, you're not bearish, but you're certainly not bullish. And I want to make sure that everyone understands the clear distinction between those two things, because when the markets are not bullish, this is where the markets can continue to grind higher, but you don't think that the markets can go significantly higher from here. It's very important that when you feel this way, which many of us feel right now, what you want to do is you want to make sure that you utilize strategies like selling cover calls on the stocks that you own, selling call credit spreads, because what you want to do is you want to take this time to collect premium, because buying put options are really expensive. How can you pay for those puts? You have to collect premium when you're no longer bullish on the markets, because markets can stay in this not bullish phase for months at a time, as we saw from many times. I would say beginning of January of 2020 is when we started to feel that the markets were no longer bullish. You know, corporate earnings were no longer growing as we were expecting. Corporate profits were no longer growing. So we were in this phase of not being bullish. That's when you want to start selling cover calls. Take profit on your stock positions by selling cover calls. Sell call credit spreads to collect some premium, because you're going to need that premium if and when the markets do correct. That actually took 3 months for that to happen, right? From January to basically, from November to February. And then once we had that sell-off, it was a major sell-off. Buying put options during that sell-off would have been very expensive. But what you want to do is you want to start preparing for that now. I want to make sure everyone understands this. If this makes sense to you, please type 1 into the chat window, that when you feel that the markets are no longer bullish, this is the time to start collecting premium, because you're going to need that for trading. So just to look at the markets right now, right? So I'm going to use the weekly chart here for something's wrong here. I don't know what's wrong. Something does not look right with this chart. I'm gonna have to figure out what's wrong here, but something, this moving average here does not look correct. So I'm gonna actually, I don't know what's going on here. All All right, so we have a weekly chart here on the left-hand side. We have a daily chart here on the right-hand side. So what we see is that one of the things I want to point back to is that during the November to January rally, as the markets continue to move higher, we saw momentum actually continue to not make any higher highs. Momentum actually started to make lower highs. These were the signs of exhaustion that we saw in the markets leading up to that leading up to the February 19th peak. Now, again, what that doesn't provide us with is an indication as to when things are going to turn around. It just tells us that things are not really okay. This is quote unquote not bullish phase that we anticipated in the early in the late stages of that rally. Now we're starting to see some of that again in the current market rally. As markets continue to move higher, we are not seeing momentum continue to move higher. It is actually continuing to move a little lower. So these are the signs of exhaustion that we are currently seeing. Now, again, this exhaustion can continue to go on for quite some time, right? This is not to say that the markets are going to drop. As far as how long will this market continue to grind higher, there's nothing that we can necessarily look at to tell us that the markets are going to start correcting. So it's important that just while we're in this not bullish phase, that we take a look at utilizing strategies like selling call credit spreads, selling put credit spreads, because in this type of market, you have a very range-bound market. And what you can do is if you look at an hourly chart, you'll see that you can utilize momentum indicators like RSI. These are perfect conditions to sell credit spreads. For those of you that want to take a look at my webinar on credit spreads, this is the best time to utilize this type of strategy, because it's important that you think about how to utilize these charts, utilize these types of technical indicators to give you a sense for when things are not looking okay. You know, same thing. The other thing also is just that as markets continue to move higher, money flow actually continue to look significantly weaker on further rallies. Money flow momentum did not confirm these new highs, and that was really our indication that it's time to sell credit spreads. It's time to sell cover calls, start taking profits on your trades, and then start looking at getting out of these particular strategies. And we're looking at the same type of market right now. So it's important to think about it's in my opinion, most important to actually think about what to do now, because when things turn, things will turn very quickly. So how do we know when things are going to turn? How do we know when markets are going to start correcting lower? That's where we can look at certain timing indicators. So the entry for a portfolio hedge should be utilizing certain types of volatility indicators. So one of the ones that we looked at during this current correction is the VIX, and we will look at VIX contango. We look at when front month versus later month VIX inverts. So when the front month VIX, many times what we do is we measure the 3-month VIX versus VIX ratio. When it falls below 1, that's usually a good indication that risk is off. And then when it goes back above 1, that's when risk is back on. And we'll talk a little bit about exiting a hedge, but let's first talk about entering a hedge. Now, as you can see, this actually triggered when the VIX 3-month when the VIX fell below, when the VIX 3-month fell below the VIX. So when the later month VIX when the VIX was greater than the 3-month VIX. I know some of these ratios sometimes gets confusing. This actually triggered on February 21st, which is just 2 days after the peak of the S&P 500. So it was a very quick indication of when things started to turn around. So, and you can use operators like this to look at it. I'll pull up a line chart just to show you. Look at a daily chart. As you can see here, the VIX 3-month fell below the VIX 1-month on February 21st. That's just 2 days after the peak of the overall market. So it's a very quick indicator of telling us when things are starting to turn lower. And you can actually scroll back here. Many times throughout the year, it did peak below it, but it moved right back above. The last time it really spent any significant time below it was December 2018. So this is an indicator that you can take a look at to say, you know, if things start to accelerate to the downside, I would keep an eye out on the VIX versus the VIX 3-month, because once this turns negative, that's usually a very fast indicator of things are starting to turn around. Might be time to pull the trigger on buying a put option for your portfolio. So again, don't go out there and buy puts right now, because many times, there were a lot of investors during the January to February rally. I certainly got a lot of questions from users asking, let's see. Okay. There were a lot of investors that emailed us saying, especially during these times, as saying VIX is really low, buying protection is really cheap. Should I go and buy protection? Yes, protection is really cheap, but cheap protection doesn't really do you much good if the markets don't correct, no matter how cheap it is. A put option is still going to be worthless at expiration, no matter how cheap it is. So keep that in mind. Don't go out and buy puts in anticipation of correction, because chances are you're going to lose a lot of money most of the time, and then only once in a while will you be right. But most of the time that you're wrong will offset any of the gains that you have here. So it's really important that you don't go out and buy puts just because puts are cheap, or just because you think that maybe things might turn around soon, because things can certainly grind higher for significantly longer than you can continue to pay for put options. So what's important is that now you collect premium. When things are not bullish anymore, start collecting premium. That process can last weeks or months before the markets start to turn around. Once the market starts to turn around, using VIX, and you can use VIX as your indicator, then you want to start buying puts. Puts will be more expensive, but you're not buying puts unnecessarily. Does that make sense? Please type 2 into the chat window if that makes sense to you. Okay, perfect. Lastly, now we'd want to talk about the exit. When do you want to exit a hedge? So one of the things that a lot of quantitative analysts look at is the fact that volatility peaks usually a few days before the market actually bottoms. Okay, so if you look at the VIX peaked. I'll show you a chart here. The market bottomed, I believe, on March 23rd. The VIX actually peaked here on March, I think it was the 17th or so. So quite a few days before the actual market bottom, the VIX peaked. So what you generally will see is near a market bottom is that as the market continues to move lower, VIX also moves lower along with it. When you see that, when you start to see that, that's usually a good indication that we are near a market bottom. This is what we call vol-a-vol. So the volatility of volatility starts to fall before the market bottom. And that's usually a good sign of a market bottom. So many times we look at days when you have multiple days in a row where the market continues to move lower while VIX also moves lower. That is a good sign that we are near a bottom, and that might be a time to start unwinding your hedges. So if you bought a put option, start taking profits on those put options when you see multiple days of market declines with volatility declining. So I'll just show you a chart of that as well. So this is the VIX. We'll use a line chart to make it a little easier to see, and we'll compare it to the S&P 500. As you can see here, the VIX peaked here on March 16th. The VIX peaked on March 16th. The market bottomed on the 23rd. So you have a full 7 days, 7 calendar days, or 5 trading days where the market continued to move lower, but VIX moved down from roughly, I don't have levels here because I'm using percentages, but the VIX at that point fell, I think, almost 30 points from the peak as the markets continue to move lower. So that's usually a good indication for when you might want to exit your hedge. So those are the 3 most important timing things to think about when you're thinking about putting on a hedge for your portfolio. In my opinion, that is more important than what actually hedge you put on, which we will talk about here as well. So we're now that we've discussed the timing, now let's talk a little bit about how do you put on a hedge. So first of all, we have to pick a hedging instrument. Now, this is really where for most users, that have a well-diversified portfolio, you want to pick something that's highly correlated to your portfolio. So if you have a well-diversified portfolio, you would likely use something like SPY or an S&P 500 index, or something that's very highly correlated to the S&P 500 index. Some of you might have more of a tech-focused portfolio, which many of you do. You tend to find that your portfolio consists of mostly the big tech names. Then you want to focus more on perhaps a tech-focused index, such as the NASDAQ 100. And then some of you may have very concentrated positions in a particular sector. Some of you may have worked in a particular company for a long time and have acquired a lot of stock in that particular company. And perhaps you have a lot of exposure to a specific sector because you work in that sector and you know that sector, so you buy a lot of stocks in that particular sector. Then you might want to be more focused using a sector ETF. But the goal is to pick a index that closely matches your portfolio. Now, if you don't have a tool that your brokerage firm provides, and most brokers do provide something like this, Morningstar has a thing called a portfolio X-ray. This gives you an idea as far as what your portfolios consist of, so that you can get a sense for where you have the most exposure. So for example, if you have mostly large cap stocks, as you can see in this particular portfolio, mine is predominantly large cap stocks, and it's across value and growth. I would use something like an S&P 500 or maybe even the NASDAQ 100, which consists of almost entirely large cap stocks across the spectrum of core value and growth. So you generally want to use some kind of portfolio tool like this to get a sense for what does your portfolio consist of, what sectors you have a focus on, and then picking an index that closely matches that. And then what you want to do is you want to start thinking about expiration dates, okay? So most of these corrections tend to be fairly quick and violent, especially in our current new volatility regime, is that we have longer and longer periods of these, what I would say, VIX compression periods, followed by very, very large explosions in volatility that tend to be very quick and very violent. So in that particular environment, generally speaking, you may not be holding onto a hedge for that long, actually. If you think about this particular sell-off, this 35% sell-off, it lasted pretty much just a single month. Now, the thing about buying options or put options on your portfolio is that what's really working against you is time decay. Time decay is the biggest thing that is going to offset the gains of your put option. So how can you optimize your hedging by picking the right expiration date? And the answer to that is simply using longer dated options. So generally speaking, longer than 2 months is a good time frame to start, because what you're trying to do is you're trying to minimize your time decay. Can you buy a 1 month option and simply hold it onto for a whole month? You absolutely can, but during that 1 month, you're going to experience a fair amount of time decay, as opposed to if you want to hold on to it for a month and you bought, let's say, a 3 month option. What you're going to notice is that during that 1 month, you're going to decay less. So in this particular case, you lost maybe this much, versus if you traded a short-term option, you might have lost twice as much or 3 times as much. So it's really important that when you're buying an option, you buy a longer dated option, even if you only plan on holding it for 3-4 weeks. Then if you buy that 3 month option, only hold it for 3-4 weeks, the time decay you experience during that time is going to be significantly less than if you bought a 1 month option. So I want to make sure everyone understands that. So please type 4 into the chat window if that makes sense, that when you're buying a hedge, you want to buy longer dated, even if you hold on to the trade for a shorter amount of time. So expiration date selection, very important. Now let's talk a little bit about strike prices. This is really where it depends on how much protection do you want to buy. Think about an insurance policy. Think about your health insurance. You can buy different levels of protection, right? You can buy catastrophic insurance that protects you in case of a large catastrophic event, or you can buy very comprehensive insurance that covers you for pretty much everything. And just like insurance, catastrophic insurance is cheap, comprehensive insurance is expensive. Now, many times I tend to find that most investors gravitate towards buying catastrophic insurance, and mostly because it's cheap. Most people do not want to spend a lot of money buying those put options. They're thinking, well, if the market makes a big move, those out of the money options will give me a better rate of return on that particular move. So I'm going to buy those cheap options. They cost less, but many times cheap doesn't provide you with much coverage. And I'm going to show you why. So cheap options are what we typically call out of the money options. So usually about a 30 to 40 delta is a good starting point. And then you can buy comprehensive insurance. These are in the money options, usually about a 50 to 60 delta option. So slightly in the money, not too far in the money. These will cost usually anywhere from 3 to 5% of your portfolio value. Now, this is all looking at roughly 2 months out. This is the type of insurance that you would be buying in your portfolio. So I'm going to show you both. I'm going to show you why when I hedge my portfolio, I prefer using something like a more comprehensive insurance, even though it's more expensive. I will show you why in most scenarios, this will give you the better outcome between the two. So that's a quick review of how do you think about your portfolio hedge? How do you think about timing your portfolio? And then once you've decided that you're ready to pull the trigger on a timing portfolio, now we'll show you how to actually analyze a particular trade. And for that, we're gonna go to OptionsPlay. So this is a tool that everyone has access to either by a free trial or if you're a member. And what I'm going to do is I'm going to show you how I'm going to set up OptionsPlay to analyze a comprehensive hedge and a catastrophic hedge. So I'm going to start with 100 shares of SPY. I'm going to use that as a proxy for my portfolio. And then, and you can use any ETF. So if you have a NASDAQ 100 index, you can use the Qs. If you have if you have, let's say, a financial focused portfolio, you can use XLF. Find an index that closely mimics your portfolio. And then what you want to do is you always want to have 100 shares, a long 100 shares to mimic your current portfolio. And what we're going to do is we're going to modify these two other strategies to be a long put. So what I'm going to do here is I'm going to look at a long put. I'm going to go out roughly, let's go out to July, which is 71 days. So a little bit more than 2 months. And what I'm going to do is I'm going to look at maybe let's say a 292 strike, which is a few dollars in the money. And then what I'm going to look at is a same thing, a July. And I'm going to go out to, let's say maybe a let's do a 280. Let's see, 287. Let's go a little higher. Let's go 297, and let's go 277. So one is $10 in the money, one is $10 out of the money. So this represents my comprehensive insurance. This represents my catastrophic insurance. Now, to make this a little bit more real, what we're going to do is we're going to use our risk and investment calculator. We're going to type in how large your actual portfolio is. So let's just say, for example, I have a $250,000 portfolio. And what this does is it automatically calculates the number of shares to mimic a $250,000 portfolio. And then it also at the same time calculates how many contracts I need to purchase to hedge my $250,000 portfolio. So here, the comprehensive insurance costs $17,000. The catastrophic insurance costs only $10,000 on my $250,000 portfolio. So $10,000 divided by $250,000 portfolio is roughly 4%, right? So we said it was in the 3 to 5% range for the, well, things are a little bit more expensive right now because VIX is still trading at 30 vol versus back in February, VIX was trading at 10 or 11 vol. So 4% for the catastrophic insurance. The comprehensive insurance is roughly 17.5. Divided by my $250,000 portfolio is 7% of my portfolio. So the cheap insurance cost me 4%, the expensive one cost me 7%. So think about it, 7% of your portfolio gone in 2 months if the markets don't correct any lower. That is a fair amount of premium to be paying, and that's why buying put options are so expensive, and that's why you shouldn't just willy-nilly go out there and buy insurance hoping that the markets are going to correct, because if you do, you've lost 7% of your portfolio in just 2 months. So that's why it's so important that in this particular time, you collect premium on your portfolio by selling cover calls. Right now, with volatility relatively high, you're actually going to get a fair amount of premium, but you might end up collecting premium for a couple of months before the market's correct. So you might be able to pick up a few $1,000s in premium. You might not be able to collect $17,000 in premium, but you certainly would be able to collect a fair amount of premium, at least maybe somewhere in the $5,000 to $7,000 range. That's going to significantly reduce the cost of buying these put options when you do need them. So let's take a look at these strategies. I'm going to use the P&L simulator here. So the first thing I'm going to simulate is what happens if, let's say, a month from now, the markets still stay where it is, meaning we grind a little higher, we grind a little lower, and the market stays around this 290 area. Let's say that happens, and let's say we're talking about mid-June, the markets are kind of maybe moving a little lower, and I'm sorry, the markets are staying where it is, and we haven't really moved anywhere. So first off, this is really where, in my opinion, the comprehensive insurance, which is more expensive, even though it's more expensive, is far better. And it really comes down, it all comes down to time decay, because when you buy this out of the money option, it's all time value, it's all time decay, and it's going to decay fairly rapidly. So as you can see here, as the markets continue to move lower here, as the market stays where it is, what's going to happen is, let's say a month from now, right now it's March 7th, let's say by June 7th, the market is still where it is. As you can see here, the market here in this particular case, I would have gotten, it's still pretty much flat here in my overall portfolio. But my comprehensive insurance, which cost me 7% of my portfolio, would lose about $3,700 worth of value. So that's the time decay that I would experience in 1 month out of the $17,000 that I pay is about $3,700 in time value. On the catastrophic insurance, because it's all time value, I'm losing $5,300. And this is really where, in my opinion, it's really, even though you're buying cheap insurance, it's going to evaporate at a much faster rate if the expected move that you want to see, it does not materialize, or if maybe the markets start to move lower and then just starts to move back very quickly, and you don't get out fast enough. So this is really where the catastrophic insurance, in my opinion, does not play out very well. Now, if the markets move a little bit lower, let's say it moves down to 270 or so. If the markets move down to 270, here I've lost $15,000 in my portfolio. Not a small loss, but if I bought these put options, these comprehensive insurance, I'd make $9,100 back. So instead of losing $15,000 and I make $9,000 back, I'm down roughly $6,000 here on this particular trade by buying the more comprehensive insurance. Here, I'm only making $2,600. So even though that the markets have corrected down to 270, it's a small correction, not a major one. But here I've lost $15,000 in my portfolio, and I've only made $2,600 back on my catastrophic insurance. So if the markets move a little lower and doesn't accelerate to the downside with a strong force, I'm really significantly worse off with the catastrophic insurance. Now, if the markets start to continuing to move lower, let's say it revisits the 243 level, which was a major support level that we've been talking about in our market outlook sessions. Here, now I've lost $38,000 in my portfolio. So now I'm talking about a significant hit to my portfolio in my stock portfolio. The catastrophic insurance, the comprehensive insurance would make $31,000 on that particular trade. And that would offset the $38,000. So I'm down about $7,000 or so in my portfolio instead of being down $38,000. The catastrophic insurance would make $21,000 back. So between the two, the 38 and the 21, I'm still down on another $17,000. So I'm certainly significantly better off than if I didn't hedge it, but I've only hedged about half my risk, even in a fairly severe sell-off here down to 240. Now, if the markets continue to move lower, you'll see that pretty much at this point, I won't lose much more than $10,000 with my catastrophic insurance. Even the market goes to zero, I'm only capped at roughly about $10,000 worth of losses here. I'm sorry, about $6,000 worth of losses here. So as you can see, $51,000 loss in my portfolio, I make 44 of that back with my comprehensive insurance. Here I lose 51, I make 33 back. So roughly here about 17. So the difference between these two is the fact that I can lose roughly no more than about $6,000 here in this particular scenario. And in this particular scenario, I'm losing roughly 14,000. No, 17,000, 17 to 18,000, somewhere in that range. So that's really where the difference between the extra $7,000 that I paid here will actually deliver me, in this particular case, an extra $12,000 in savings in my portfolio. So this is really where the catastrophic insurance provides you with much better coverage than the catastrophic insurance. Now that's to be expected, right? Because I am paying more. I'm expecting to get better protection. But really, in my opinion, the best thing about the catastrophic insurance is the fact that even the markets don't move very much, many times you will still get some coverage. Many times the catastrophic insurance, let's say the market moves down to 270, meaning it doesn't move very much, what you actually end up with is still a loss on the catastrophic insurance. So imagine buying protection, the markets move down to 270, and you've lost more money than if you didn't buy protection. That is in my opinion, a painful experience to have, is to buy insurance, the markets move lower, and then lose more money than you originally started with if you didn't buy a hedge. And that's why, in my opinion, I think it makes the most sense many times to buy the more expensive option, especially if you're timing this correctly, meaning you're not just buying protection hoping that the markets are going to correct, that you only buy protection when the markets start to correct using the timing indicators that we talked about here earlier. Now, these timing indicators, we are keeping an eye on this. So for those of you that are joining us on Tuesday and Friday mornings, we've been talking about the VIX going into contango, going back into backwardation, and looking at the two and seeing when we're in this risk on, risk off environment. I will say the market has kind of flip-flopped a lot over the last few weeks, but right now the VIX is very much in this risk on mode. But the signs of exhaustion that we're currently seeing puts us in this risk on but no longer bullish phase, because momentum is starting to we're seeing negative divergence on the momentum. Money flow remains to be very weak on these subsequent rallies. Volume continues to decline on each subsequent rally. So these are all signs that markets are starting to show signs of exhaustion. Small caps, same thing. So we're seeing this across the board, but again, that doesn't mean that the markets are going to correct now. So when we're in this current phase right now, the best thing to do is to make sure that we think about collecting premiums, selling cover calls, selling cash secured puts. Sorry, not cash secured puts. I don't think you want to do that right now. You want to sell credit spreads right now. Collect that premium, because if and when it comes to buying that protection, you might end up paying 10% of your underlying portfolio to buy a put option. Hopefully at that point, you've already collected 4 or 5% of premium in order to do so that you're actually only net paying about 5% of your portfolio to buy this protection. But that's the rule, is that you want to do that now so that you don't have to wait, so that when the markets start correcting, you have some premium in order to do that. So that's what I wanted to show you here today. It's really important that you utilize a symbol that mimics your portfolio. So make sure that you select one that closely matches your portfolio. So for those of you with tech portfolios, to utilize an ETF like the Qs instead of SPY, or XLU, XLF, whatever sector ETF, perhaps if you have a sector focused portfolio. This really allows you to get the best possible protection on your portfolio as the markets correct. And just a quick review before we wrap this up and start answering questions is make sure that you always have the stock portfolio on the left-hand side. You can set up 2 put options by using our strategy constructor, selecting put options. And again, make sure that you always start off with an expiration that's roughly 2 months out as a starting point, perhaps going out a little longer if you do have, SPY obviously has far more expirations than some of the other ETFs, but I would start with a minimum of July in this particular case, which goes out 71 days. And then you can also construct different strike prices. You can say, well, what happens if I buy this 215 versus maybe a 227, something that's roughly $6-7 out of the money, or $6-7 in the money, and compare the two. And the best way to do this is first enter your portfolio size. So if, let's say you have a $70,000 portfolio, enter that so that you mimic a $70,000 portfolio. And it also calculates the appropriate number of contracts for you so that you are comparing something that's actually comparable for your portfolio. This allows you to then see what happens if the market moves lower by a specific date. You can even make volatility assumptions, because we know that as markets sell off, volatility increases. You can make some of these adjustments and see how much protection are you actually getting from the catastrophic insurance, how much protection are you getting from the comprehensive insurance, and then making a decision on your own. You might even want to select, an at-the-money option instead of any of these options. So this is really where you can utilize OptionsPlay to your full advantage and learn how to be self-sufficient in being able to analyze one of these hedges for yourself, because markets can continue to move higher for another week, another month. We really simply do not know. But when the markets do correct, things are likely going to move very quickly. So it's important that we know how to utilize our tools to be able to analyze the trade on our own. So that's the important part that I wanted to go over with you here today. So thank you so much for taking the time out here this afternoon. I really hope that you guys are able to take something away from this for your portfolio. And just a quick wrap up before we open this up for Q&A. Constant hedging is not cost efficient. So don't try to go out there and buy protection all the time. You're much better off being late than early. You only want to hedge when you're bearish. When you're not bullish, what you want to do is you want to make sure you sell covered calls, you sell credit spreads, and you collect premium that's going to help you offset the cost of buying puts if and when the markets start to correct. You always want to generally look at in-the-money puts, because they provide better overall protection. But for those of you that only want catastrophic insurance, you want to buy those out-of-the-money puts. So that's a quick review of what we went over here today. I hope that you guys find this useful for your own portfolio, especially going into this, what I would say, challenging time to trade these markets. And also for those of you that want to keep on top of where we actually are in that cycle, please join us on Tuesday and Friday mornings. We do that every single week. I'll post the link to how to join for those of you that have not signed up for that. I'll just post the link into the chat window if you want to sign up for our Tuesday and Friday morning session. And before I open this up for Q&A, I just want to remind everyone to allow us to continue doing this every single Thursday and providing this type of research and education for you guys. Please consider supporting us by becoming a member by going to this link on your screen, and I just posted that into the chat window. Membership is just $75 a month or $500 a year, and it gives you access to everything: the platform, the daily trade ideas, the weekly education, the weekly market outlook sessions, and all the different reports that we've been building that are now going to be incorporated into OptionsPlay to show you how to access different platforms to show you, things like liquidity that are really important. This is something that we highlight a lot in our morning outlook sessions, to look at how many symbols are liquid. For those of you that are figuring out what symbols to trade, trading the liquid symbols are very, very important. Also, earnings calendar. We have passed the bulk of the large cap companies, but you still have a lot of smaller cap companies coming up. You have Home Depot, you have Costco, you have a lot of big names that are still coming up here. So important to know what earnings are coming up. More importantly, what earnings are coming up that are liquid from an options perspective. We only try to trade the ones that are very liquid. So this is all available to you as a member here for OptionsPlay. So again, I want to thank everyone for taking the time out here this afternoon. Thank you for supporting us and allowing us to continue doing this and providing this type of research and education for you guys. So with that, what I'm going to do is I'm going to turn this over for Q&A. What I'm going to ask is that if you have a question, please type them into the Q&A window. There's a chat window and there's a Q&A window. Please type your questions into the Q&A window and I will answer your question there. So thank you so much, and let's go take a look at the questions here. So